Hi everyone. So episode 11 of Rob's Roundtable, and I only got a couple of questions to answer. There's just three. One of them could be quite a lengthy answer because I feel it's quite important, and there's quite a few points I'd like to touch upon with this. And traditionally, I've always gone in order of how the questions have been sent over to me, but I'm going to leave that one till last. Okay, so first off, England in the final, fantastic. Played very well. I didn't see all of the game, but I saw the Spanish against the French, and my word, what a game! And England should be able to put up a good performance. Hopefully, they won't come across the same Spain as what I saw. But hey, it's going to be a corker of a game. So hopefully it lives up to that hype. Best of luck to them. So let's crack on, guys. Okay. First question. I heard about ETFs. What exactly are they? So ETFs is just an acronym for exchange traded funds. And essentially what they do is they track a particular asset. Okay, so if you think about the FTSE 100, you could get an ETF that you invest into that tracks the whole of the FTSE 100 rather than if you were to buy an individual stock that's in the FTSE 100. Okay, and it's a great way to apply diversification to your portfolio, because if you think about investing into the fund that's tracking the FTSE 100, the performance of the fund is reliant on those 100 companies within it. Okay, so if, for example, one of those companies goes bust, you've got 99 other companies, okay, that would keep your investment going. Although it would never drop down to 99, because you'll have another company that will come in to replace it. So it will always be 100. But in theory, that's how it would work. Doesn't have to be, okay, an investment or an ETF that's tracking a particular index. It can be tracking a particular asset, such as commodity markets, such as metals, precious metals, for example. It could be tracking a particular country, kind of the performance of the country. It could be tracking bond markets. Okay, it could be tracking anything. Okay, so that's what an ETF is, and there's great benefits of investing into an ETF. It trades very much like a share. First of all, the actual fund, the price is live on the market, so you can see it go up and down, where traditional other funds like mutual funds and something called OEICs, open-ended investment companies, which is kind of similar to a mutual fund but in the UK, they are only priced once per day, and it's normally at the back end of it. Okay, so you don't get live pricing of your investment. And with ETFs, you don't get stamp duty that you do with individual investments. And there's numerous other benefits as well. They generally are very much cheaper than traditional investment funds as well. Yeah, there's other pros as well. So another question, tracking my calories, should I weigh my food raw or cooked? That's a great question. And personally, okay, I've always weighed my food raw, partly because it's hard to actually be consistent with weighing it cooked. Okay, if you weigh, for example, beef mince every single time raw, okay, then obviously it's always going to be exactly the same. But when you cook it to 200, let's just say you get 200 grams of beef, I know if it's raw, it's X amount of calories. If I cook, okay, that 200 grams to, let's, for example, say pan fried, or whether it's deep fried, whether it's grilled, whatever it is, okay, it's hard to be consistent with that, because it's going to be different every single time, okay, I cook it. And also as well, adding the what am I cooking it with, it's hard to obviously track the amount of, for example, if you are, let's just say that pan frying it, are you using butter, are you using olive oil? You're not including, typically not in going, it's going to be hard to include those exact amounts, okay, with your cooked weight. Now, I have actually looked into this, and there doesn't seem to be a, I suppose, broad agreement of how exactly you should weigh it, and a lot of advocates go down the weighing it raw route. Some people, to be fair, do actually say always weigh it cooked. Personally, I think the most common answer, the most broadly agreed answer, is as long as you're consistent with how you're weighing it, it really doesn't matter. Because after all, don't forget, I go back to this all the time, that the 20% allowance of discrepancies between nutrient amounts, that's on the back of each type of food you buy. So even if you are 100% accurate, whether you're weighing it raw or cooked, you might be 20% out due to the information that you're getting that from. I mean, if you look, or for example, Google nutrients in, let's just say, I don't know, nutrients in 100 grams of salmon, all these different answers will come up, and they will be very different depending where you look, or maybe not very different, but they will be different. So I would always do it raw. But as I say, as long as you're consistent, that's the most important thing. So the question I want to spend the most time on is, and I thought this was a fantastic question. I mentioned risk management, is very important when it comes to investing. What are the best ways to manage risk? Well, great question. And the honest answer is, it really depends on what you're invested into. What type of asset it is, because there's going to be different risks associated with each individual investment. And the important thing is to understand, if you are going to invest or trade into any investment, it doesn't even have to be marketable assets. It could be investing into a bank, putting your money savings into a bank. That's risky. People say, well, banks don't fold. Well, do they not? Cast your mind back, over the last decade or so, there's been quite a few banks that have gone bust. So do note that risk is inevitable. You can't avoid it, and the best traders, best investors do understand that, and they put into place their own types of risk management processes in their investment. Now I'll use investing into equities or into shares or stocks as an example of managing risk. What type of risks are associated with using the stock market for your investments? Well, first of all, are you investing into an individual company, or, like I mentioned already, ETFs? If you invest into a company, obviously you've got market risk, which means the share price can move up, can move down, and obviously moving up could be a risk if you've shorted that particular stock. We'll go over shorting at another stage, but obviously if you, for example, have invested into Shell, then obviously there's going to be risks of what could potentially move that individual stock, that will cause its share price to fall. Obviously they are extracting oil, and selling it, so therefore the risk is, well, for example, oil price could move down, and if it does drop, then obviously Shell will get less profits, or there's potentially a risk of gaining less profits. So therefore, obviously, people will be more reluctant to invest into that company because they foresee that they're going to be less profitable in the future. That can affect your stock. So you need to put into place some type of way of managing that. So you could put, for example, that when you invest into Shell, if you were to looking to invest into Shell, you could put in something called a stop loss in place. And a stop loss is a trading command that you give your broker, that if, for example, they're trading at £20 a share, you could put a stop loss in at £19. So if the share price, when you invested into, is £20, you've paid for them, and the share price does plummet down to 15, your broker will know that you're looking to sell Okay, your shares, you're looking to offload them at £19. So it's stopping that loss, it's capping that loss at the amount of £19. Yes, you will lose £1 per share, but you've stopped the loss, you've managed that risk of it falling any further. Okay, that's one way of managing the risk of something like that scenario. Another example, is doing your due diligence, into the investment before you purchase it. And there's one of the famous Warren Buffett's components of investing, if you like, or rules of investing, is know what you're investing into. If you don't understand, the risks of the investment, you haven't done your due diligence. You need to understand all the risks associated with your investment, and that will help you define the risks associated with it. And also as well, understand that one of the most important risks to manage, which we have, to be fair, just gone over, but it's managing that loss, because that is so important. And I've written an article, I can't remember if I've released it or not, to be honest. I wrote it a long time ago, and if I haven't released it, I will release it fairly soon. But there's one of the most famous quotes by Warren Buffett himself is, there are only two rules to investing, and that's one is don't lose money. The second rule is don't forget rule number one. And people don't understand that. They laugh at this, but they don't understand what that actually means. And they're laughing because, well, it's an obvious statement. No one invests looking to lose money. But the important thing around this, is how hard it is to gain back losses. If you invest, for example, let's just say £100 into an investment and it loses 50%, you're left with £50. So, and I used to ask this question a lot when I taught this area, and not many people got it right, is how much percentage would it take for you to get back to your original £100 if you lost 50%? People will say, well, 50%. You lost 50%, gain 50% back. But if your profit has gone down to £50 and you gain 50% back, well, 50% of £50 is 25, so it only goes back to £75, not £100. So it will take 100% to get you back to the £100. Obviously, we're not including the money already you lost from your broker fees, as well as the stamp duty of buying a UK stock. That's why it's so important, and this is why Warren Buffett says that, because if you lose money, it takes so much effort to get you back to your original position before the loss. That's why it's important. So the best ways to manage risk is, first of all, do your due diligence before you invest. Understand all the risks associated with that individual investment, and then go into how to manage it. If you're investing into bonds, obviously there's a danger, for example, of credit risk. That just means there's a potential chance of the issuer of that bond defaulting on paying you back either your principal or the coupon that is attached to that bond. If you invest into for example forex, the chance of interest rates moving, that could diminish the value of your position. All these different things, and this is why I say it's very different depending on the asset you've chosen to invest into. So that's what I would say surrounding that. I hope that makes sense, but it really is such a broad topic. Risk management was a subject in its own right, and it took me just under a week, but I could have gone into it for several weeks, to be honest, because it's such a big area, but it's a very important one. If you do have any more questions surrounding that, I hope I've answered the question sufficient enough for what you're asking me. But if not, obviously you know where I am if you want to know more about it. But guys, that's it. Only 3 questions this week. So guys, have a great rest of your weekend. I can't remember when the England game was, but I'm sure it is Saturday or Sunday. I think it is Sunday. So hopefully, obviously, next time we speak, we will be European champions. If not, better luck next time. Guys, have a great one. Take care.